Okay, so let's go ahead and move on, and let's start to look at some valuation structures. So I'm opening up the valuation model structures quick sheet, and I sent this to you through WhatsApp this morning. Also, you have it on Canvas. And as we look at this, we see a couple of things. I have right up here at the top, the basic structure is a value is equal to the present value of some discounted cash flow plus the present value of some continuing value. And then I've organized this such that this column is all the present value of the discounted cash flows for these various models. This column is the continuing value, and this column is the present value of the continuing value. So I did this in hopes that you would quickly see that there is a common thread amongst most of the valuation models. They virtually all start with the sum of some cash flows discounted for rate and time during an explicit period of time. Whether it's a generic cash flow as we have in this model form, or free cash flow as we have in the free cash flow model, or it's the forward market multiple model, which you don't know yet, but you will within a few weeks, or if it's the APV model that we'll talk about a little bit more today. They all start with taking the present value of the discounted cash flows that are available during the explicit period of time. And then to those, they add the present value of the continuing value. Well, to do that, we've got to identify the continuing value. Notice in this case, these are all continuing values as of time zero, exactly as you would expect, and this is continuation time zero. So what period of time is commensurate with continuation time zero? Do you recall?
The time before the continuation starts?
Exactly right. It's the last year of the explicit period or the year before continuation year zero. That's exactly right. So we simply identify this, and each one of these are some variation on the theme of some cash flow, and I'll use the free cash flow model to look at this one, some cash flow divided by some discount rate minus a growth rate, because this is effectively the Gordon growth model, right? Now, it happens to differ when we get down here to the forward market multiple model. I'm not going to spend any time on this today because we're going to be spending time on it for the next couple of weeks, okay? And so this document will help you beyond simply today. But we find a continuing value, and then we're going to take the present value of that continuing value, and we're going to add it to the present value of the discounted cash flows. It is that simple and that hard all at the same time. So virtually all models that we're going to deal with for valuation follow this same structure. Now, some models are going to look like we move directly to the continuing values. And we're going to bypass the use of the present value of any discounted cash flows. Under what condition would bypassing the present value of discounted cash flows be a valid model?
When the long-term growth is the same than the growth for the explicit period?
That's exactly right. When the growth rates don't change, in which case there's no sense in going through all the trouble of doing these summations. Just move directly to the Gordon growth model. Does that make sense?
Yeah.
Megan and Victor, do you understand why that would be?
Yeah.
Okay, good.
Yeah.
Good. And for those of you that aren't live with us today, if you have any questions about this, just go ahead and model something out where you use the same growth rate during the explicit period as you do during the continuation period. Find your value doing that, and then separately just find your value using just the Gordon growth model form, and you're going to come up with the exact same value, assuming you're using the same WACC and you're doing the math properly. So I've given you this valuation model structures quick sheet because some people find it helpful to see the consistent thread amongst each of the model forms we'll look at. And this sheet has more model forms on it than we're going to spend any time working with. We're not going to spend any time in the economic profit model in this class. We're not going to spend any time in the key value driver model where we only use no plat, which I don't think I have that on here. Obviously we'll spend some more time in the key value driver model itself. But there's a variation on this that you'll see where we only use no plat. We don't even use free cash flow. We won't spend any time in that model. But it might be interesting for you to not only look at this item, but read my notes here, because I think that they'll help you understand a few things that are going on. We've talked about these, but they'll be a reminder for you. I want to move on to the other valuation model quick sheet. We already know the free cash flow model pretty well. Present value of the cash flows during the explicit period plus the present value of the continuing value. You've seen these many times. And you'll see that we actually have two different versions of the key value driver model. One in which free cash flow is expressly the cash flow variable that we're using, and another in which we only use no plat during the explicit period. But in the continuation, we have the exact same structure. This form of the key value driver model that only uses no plat is a very, well, it's a unique form because it would only be used when no plat is equal to free cash flow, which is a fairly unusual scenario. In fact, no plat is only equal to free cash flow when there's no interest, there's no taxes, there's no net capital spending, and there is no changes in net working capital. Well, that's all possible, and it's all nicely theoretical. It's just not at all realistic. So for us, as we look at the key value driver model, the key value driver model will be exactly the way we've already seen it before. So we're going to take the sum of the free cash flows during the explicit period, and we'll take the sum of the discounted free cash flows, and we'll simply use the key value driver form of free cash flow during the continuation period. You've already done this a few times, so this one's not new to you at all, right? I think that's right.
But then again, the KVD model is we use it extremely rarely. That's correct, right?
In fact, you're only going to use the KVD model, Victor, when I ask you to use the KVD model, or maybe in a case or a paper in which you're trying to show me what you've learned in the class and you've decided you wanted to focus on that model because you made that choice.
For instance, on a business case, or in daily applications, would you see us using KVD at all? Or is it extremely seldomly?
I would say that it's seldom and rare. Now, that said, if you read the McKinsey text, the valuation text that they have, McKinsey and Company is all over the KVD model. They didn't develop the model. This is not their invention, but it's the one that they prefer. And it's clear to me why they prefer it after reading their text. But it's only because they make a number of assumptions that are very sweeping assumptions and very theoretical. You're going to find that if you ask any other valuation experts, everywhere from Aswath Damodaran to the people at Economic Partners, to the guys at Scalar and others, you're going to find that many of them don't even know what the KVD model is, and those that do say that it's virtually never used. It's an interesting model to consider. So let's move to a spreadsheet for a moment so we can look at what I mean by that. So here I have a company, and you should be able to see this on your screens. Here I have a company by the name of Mira Dravana Enterprises. And this is not a company you've worked with before or seen any information on, but you'll recognize the structure. You know exactly what's going on here. It starts with these financial statements, and moves into looking at the multi-columnar form to moving into the forecasts and then doing the evaluations. And in this case, you'll see that I've motivated the free cash flow model here based upon all the various cash flows. And if you look at what I'm using exactly what you would expect me to use. This is set up exactly as you would expect it to be set up, okay? And you've done this before. And I take the present value of each of them, and then I do the sum of the present value of each of them, and then I find the continuing value, and then I find the present value of the continuing value, and the value is the sum of the present value of the discounted cash flow and the present value of the continuing value. I know that you probably already realized this, but I repeat it because it's present in one of your next assignments or your next Excel assignments, and I just want to make sure that if you have any question about it at all, that you're primed to ask it here. As I now move over and look at the key value driver model, you'll notice that I'm getting almost the exact same outcome. Now 149.362 versus 149.778. So that's an insignificant difference given these are being measured in millions, right? And we notice here that the present value of the discounted cash flow is exactly the same, because we're using the exact same cash flows. Remember that we're using the cash flow from the explicit period for each one of these. The continuing values differ a little bit. This continuing value is simply taking the last cash flow and then dividing that by the discount rate minus the growth rate, exactly as you would expect. But here, this continuing value is more complex, and it's using that KVD continuation, where we use no plat times 1 minus G divided by ROIC, and then we divide all of that by WACC minus G. Now, when we've looked at the KVD model compared to the free cash flow model before, we've seen bigger differences in outcomes than we're seeing here, haven't we?
Yeah.
In fact, usually when we look at it, we see the outcomes are widely different. So why is it that in using it this time, the outcomes are not identical, but nearly so? What does that tell us? Well, what it tells us is this long-term G that we're using is an accurate representation of the growth rate that we experience as we go into the actual explicit period. Okay, so remember, the reason that the free cash flow model and the KVD model often differ is because that G that's being used isn't necessarily reflective of the actual experience and isn't reflective of what should be able to be accomplished with that ROIC and the firm's existing capital structure. But in this case, it is consistent, so much so that we end up with virtually identical values.
So like, can we say that the G is how can I say that? Can we say that we guess G pretty good when we have a KVD model and free cash flow model equal, like almost equal?
I think that's exactly what you can say. That your guess about the long-term G was relatively accurate. Go ahead now and focus on the APV model, or the adjusted present value model. To do that, I'm going to go ahead and open up the valuation model structures, or the quick sheet on valuation models, and then we'll move to a spreadsheet that talks about them. So I'm going to share the screen again here. And we'll open up this form. So think about this with me for a moment, if you would. I believe that we recognize that the value of an asset is the expected future cash flows from that asset discounted for rate and time. And we looked at free cash flow as being the cash flow from companies for the most part. But let's think about this a little bit more pragmatically, perhaps. I think a cash flow is anything that either gives us money or helps us save money. So think about companies that have debt. And they have free cash flow. I mean, we can articulate their cash flows as free cash flows exactly as you would expect us to do. But they also have another line, if you will, that may as well be a cash flow to them. And that's a tax savings. So they're saving money on taxes when they don't have to pay as much tax because they have debt and they're paying interest expense. Remember that interest expense is deductible from taxable income, so they don't have to pay tax on that part of the income. Well, from a business owner standpoint, you can either give me additional revenue, and I like that, or you can save me expenses, and I like that. And so each of those can boil down to some notion of cash flow. And the first one becomes free cash flow, but the second one is what we're going to call the tax shield. And you might recognize that the tax shield is any interest that is paid in a time frame, in a given period, multiplied by the tax rate. That gives us the amount of savings on our taxes that we have because of the interest. So for example, if we have $10 in interest and we're at a 26% tax rate, then we get to deduct that $10 from our otherwise taxable income, and we get a $2.60 tax savings. That's referred to as a tax shield. So we're going to look at a model form here, the adjusted present value model, that includes both free cash flow, discounted for rate and time, and the tax shield, also discounted for rate and time, as two separate and distinct cash flows. Let me say that again. We're going to use cash flow, free cash flow, discounted for rate and time, plus the tax shield, also discounted for rate and time, as two separate and distinct cash flows. Let's look for a minute over here at the this example I put in front of you. The adjusted present value model, we're going to think of it as being equal to value based upon free cash flow and value based upon the tax shield. Well, value based upon free cash flow is exactly what you would expect it to be, almost. It's the sum of the free cash flows divided by 1 plus KU. That's not R, it's not WAC, it's KU to the T. So we're going to come back to that in a moment. And then free cash flow time 1 divided by KU minus G, that would be a continuing value, divided by 1 plus KU to the T. So this would be then the present value of that continuing value. And the present value of the discounted cash flows using free cash flow, and the present value of the continuing value using free cash flows is the FCF, or the value based on free cash flows. But those really embody only one of the two unique cash flows that we might see come out of this company. The other's embodied in the other part of this equation, and that's the tax shield. Before we go there, let's go back to this concept of KU. I believe that you know what R is. I believe that you know what required return is. I think you know what WAC is. But what is KU? Well, KU is another form of cost. Think about this in terms of K stands for cost. Remember that we're dealing with economics here, and economics, a lot of the language we have from it was given to us by Karl Marx, Karl with a K. Well, here we have cost with a K. Well, what's the underscore? What's the U stand for? Well, it stands for unlevered equity. And I don't want to get too deeply into this, but just recognize it's a different discount rate, and it's most closely aligned with RE, or the return on equity. So set that aside, recognize that we're looking at simply the sum of the free cash flows discounted for rate and time. The time is going to be based upon the explicit period, but the rate is going to be, in this case, KU, or a substitute for KU is RE, or the return on equity, the cost of equity. Well, that's going to then give us a value that's going to be slightly different than the value that we'd find using just a free cash flow model alone. But that would make sense to us, because we're not going to have the value of an asset be the free cash flow model, and then also have it be the value of the free cash flow model plus something else, because that can't exist at the same time. It's either the value of the free cash flow model or it's the value of something else. It can't be both at the same time, because they're additive, and that doesn't work. So let's look at this other this other cash flow as the tax shield, and let's consider its discount rate, and then we'll put them together. So we're coming back here. We can look at this and we can say the tax shield is, again, going to be whatever the cash flow is times the tax rate. And we're going to think about that as having an explicit period and having a continuation period, and we're finding the present values, and we add all those present values up, and it gives us the value based upon the APV model. Let's move to a spreadsheet and see some of this, and we'll talk a little bit further through this KU and K-tax, yet another discount rate, KU and K-tax issue while we look at the spreadsheet. So this is actually the same company that we were looking at before when we looked at the KVD model and the free cash flow model. Although it's this particular item includes, or this particular spreadsheet rather, includes the APV model as well, where the others didn't. And in this case, we also have KU and K-tax. So let's start our conversation there about the APV model by going back to KU and K-tax. Now this is Mira Dravana, and Mira Dravana is working on the same financial statement structure for this as we did when we looked at this a little bit earlier today. But here we see that we've got KU and K-tax. Well, what is KU? As it turns out, KU can be found on another spreadsheet with an equation. Well, great. Let me go to that spreadsheet. This is a financial statement. And all that we're doing here is we're going to use for KU, or for the cost of unlevered equity, we're going to use the cost of equity and the cost of preferred in an amalgam. What I mean by that is we're going to take a weighted average in this. And we'll talk more about that in detail, perhaps not until next week as we look at this model again. I want you to just get used to the model before I go into some of its eccentricities. But we're going to go ahead and use for this, we're going to use RE, or KE if you will, to be equal to KU. So it's the cost, opportunity cost of discount rate for equity or unlevered equity. We're also going to use then for K-tax, and K-tax is going to be the cost of, opportunity cost of, or the discount rate that we might associate with paying taxes. A discount rate associated with paying taxes. We're going to have to think about that for a moment. And we're going to call that equal to the cost of debt. Well, think about this for a minute. We all pay taxes. And the tax money that we pay goes to things that we may or may not think give us value. It goes to the construction on 13th East. It goes to the fire department. It goes to the police department. It goes to welfare systems. It goes to public higher education. It goes to all of this and many, many other places, of course. It goes to defense spending and Department of State and everything as we pay taxes. Well, as taxpayers, we know that we maybe could have spent that money ourselves. If I wasn't paying it in taxes, I could have had it myself and spent it on something else. So there's an opportunity cost here. And we have to think about what might that opportunity cost be. Well, that opportunity cost is referred to as K-tax. And it is largely supposed to be equal to cost of borrowing, or RD. Why is that? Well, think about this for a moment, and I think you'll connect to it. When our government doesn't have enough money to pay for goods and services that it would have otherwise paid for because of tax revenues, how does it pay for them? Well, it can print money, but that just causes inflation, depletes the currency, or, devalues the currency, or it borrows money. So because of that, when we don't have enough money in taxes at the government level to pay for something, recognizing that the government can borrow money is believed that the opportunity cost of that borrowing, which is going to be RD, or KD in this case, and RD, then that opportunity cost can be substituted for K-tax. So now let's look at this. We know, once again, when we looked at the FCF model, we got our value. When we looked at the KVD model, we got our value. When we look at the APV model, we're now looking at a structure here where we've got the exact same scenario that we looked at over here for free cash flow. We're using the exact same cash flows, but the discounting is a little bit different now because we're discounting them by KU in this case. We're discounting them by KU. And we use that same discounting as we go through each of these other steps. And that brings us to a free cash flow value of 118.12, which is very different than the 149.778 because we're using a 20% discount rate instead of the 16.95% discount rate that was in play when we got the values for KVD and FCF. Well, we then also have K-tax or V-tax. So the sum of all this tax shield as though it were a cash flow. And again, the way we calculated the tax shield is we took the interest expense and multiplied it by the tax rate. And that gives us a tax shield. And we do that for every one of these periods. Whatever the interest expense is, the tax rate. It's why we calculate the interest expense. And remember, we calculate the interest expense by first calculating debt and then applying our forecast ratio to this. So when we calculate the tax shield, we then can identify the discounted tax shield, which is exactly as you would expect, taking the tax shield and dividing it by 1 plus the discount rate. But in this case, the discount rate is K-tax. Now, sometimes you'll find that these models will assume that K-tax and KU are equal to WACC. We know that that shouldn't be the case. Let me show you what happens when that is the case. Let's assume for a minute here that we've got 0.1695, 16.95, because that's our WACC. And when we do that, we see that we now have quite a value difference. We were at 149, we're now at 154, so that's a value difference, and that would make sense to us because we see that 149 is already built in here from the value of the FCF, because this VFCF now is virtually identical to the free cash flow model because it's structured in the exact same way. But we're adding to that cash flow. We're adding the tax shield to it. So we would have to add to this VFCF, we'd have to add the V-tax to get to this APV, the adjusted present value of 154.2. Well, if the asset hasn't changed, if it's the exact same asset, it shouldn't have two different values that are this disparate, right? So we can come back up here and we'll just make an assumption that we go back to what we thought these numbers were, and this number comes closer into line maybe, or it's now not the same as it was, which simply tells us that maybe we don't have quite the right numbers here for KU and K-tax. But we're close enough on these that we're within the ballpark. Here, if we change K-tax to 4.7%, we see that our numbers come pretty closely into alignment. But in reality, most often you're going to use RD for K-tax. Let me put this back so we're using RD for K-tax. And we're back to a number that's not terribly different from, a little bit, but not terribly different from the values for free cash flow and KVD that we had before. So that's the that's the adjusted present value model. It takes a recognition that we have two different cash flows, free cash flow and the tax shield, and finds the value of each one of them and then sums those two up. And this then is another way to look at evaluation. We'll go ahead next week and start to look at this final area of valuation, and that would be a forward markup multiple model or using valuation multiples. We won't spend much time on that on Monday together, but we'll spend a lot of time on it on Wednesday and in the coming weeks.